When you have a model and you have all the proper motivation that led you up to the point where now you've made the decision, you went to sleep the previous day, you woke up with every expectation that you're going to go into this following the plan, following the model, following the rules. You're looking for this setup to form. And now you're here. You're in front of the charts. You're there. And you do what? You act impulsively. You see something that is not your model. Perfect example. I'll give you something. You've done the work. You've done the analysis. You've listened to me talk about what I think the market's going to likely draw to on a higher time frame. You committed to the idea that that's probably what you're going to subscribe to. So you're only going to focus in that direction. And that's the proper mindset. Not that you should be handheld, but that's why I do it. So that way you can keep your premise, your bias, the narrative focused on that time frame draw. You won't be 100%. But now, because you're in front of the charts, subconsciously, you're demanding that you're 100%. Is that practical? Is that realistic? Is that something that anyone could reasonably expect to have? Especially if they're new? No, of course not. But that motivation that carried you to that moment, where now you're in front of the charts, you're ready to do your model, you're ready to pull the trigger. All you have to do is wait for that fair value gap to form, because it's going to be moving up quickly, and it's going to create that little buy side unbalance, sell side inefficiency, and it's going to form it in a place where it allows you to capture 12 to 15 handles. So that means your minimum criteria for the trade would be met. It's really there, but unfortunately, it's not there yet. And what happens is you start seeing price run. And in your mind, you're thinking, this is going to be one of those times where it's not going to create a fair value gap. And here I am. I did all the work. I got all this stuff drawn on my chart. I have all the lipstick. I have all the motivation. I'm here now. And I know what's going to happen, because Murphy's Law says that whatever can go wrong is going to go wrong, and it's going to run without me. And I'm not going to be able to accept that, because I've done all this preliminary analysis. I've done all this preliminary workup, listening to this guy, Jawbone. I'm all pumped up. I'm ready to go. And here it's running. It just took off 8 handles straight, one shot. It's running. Your mind's going to be tricked by that because you haven't watched price enough. That motivation to do the right things gets replaced with impulsiveness, because the lack of experience, the lack of the doing of it, being there, not just simply watching price. That's the first stage. Is tape reading just the first stage. Then you got to do it with a demo and submit to the idea that the rules still have to be applied. But then with live fund trading, or the equivalent thereof, where you can lose something, your funded account, challenge account, your funded account, or your live account, you want to capture money. And the lack of experience that you have, and everybody has that lack in the beginning. And all of you, and I was not exempt from this, I wanted to get through that stage quickly. I wanted to leave it behind me in my rearview mirror. I want to be able to say, yeah, see you later. I ain't never going back to that town again, which is ignorance, neophyteville, beginner. Like, you want to be able to leave the ranks of a newbie. When I'm encouraging you, know what low-hanging fruit is and target that. Now, what does that mean? You probably hear multiple times, low-hanging fruit, low-hanging objectives and targets. If you're short, okay, what's the closest short-term low? If you're entering on like a 5-minute chart, where's the nearest 15-minute low? Where's the hourly low? That's going to be the closest one if the market just keeps dropping. How far away is that?